Hello everyone once again, and welcome to another episode of my company health check series. So, for those who have not, for those of you who have not watched my previous episodes or series, do remember to check them out, as I cover anything from the markets to the economy, and as well as the company individual stocks such as this, company individual coverage such as this. So, what is the company health check series all about? Here, I will share occasional updates of my portfolio companies I invested in individually and still holding. I will analyze them using the bottom-up approach, usually looking at the quarterly report all the way to the full year and beyond. I believe that by journaling my research in video format, I hope I can make myself more informed of my past decisions, whether it's right or wrong, and also share my insights with everyone else here. Hopefully, all of us can benefit in some way, especially to fellow active value investors like myself. Today, I will be sharing about my insights on Google's fourth quarter 2023 and its full year earnings release. The stock has so far been down 6.6% since its earnings release last week. Are there opportunities to buy on a dip for Google? Is this drop in the stock price unwarranted or warranted? Before we dive further, do remember to help me share, like, and subscribe to my channel, as your support is greatly appreciated. So without further ado, let's dive in. Let's first look at Google's segmented revenue for quarter 4 2023. The largest share of revenue comes from Google Search alone, and that has increased to 64% from 59% previously. All other segments take on around 11 to 14% revenue share each. Most segments saw an improvement on its quarter-on-quarter revenues. Even when we compare year-on-year growth for each segment, most segments have done well too, except there is a slight decline in Google Networks at -2%. This led to an overall growth rate for 12 months ended at 8.4% year-on-year and 14.6% quarter-on-quarter. This is indeed exceptional performance for the year ended 2023 for Google. My conservative estimate is that this year overall revenues will increase by 5 to 8%. In 2024, should superior growth such as this continue on Google Search, with increased share of revenues and continued growth on its subscriptions, platforms, and devices business. So for segmental operating income, I noted that there has been an outperformance in Google Cloud business this quarter. Its operating margins have significantly improved from 3% last quarter to 9.4% this current quarter. There is a sharp improvement of 224% quarter-on-quarter growth for the Google Cloud business operating income. And we must note that this quarter's performance have even beat its previous record high of $395 million recorded in its second quarter 2023 last results. Google Services operating income continues to grow year-on-year of 24%, providing healthy operating margins of 35%. This generated an overall year-on-year operating income of growth of 23% and an 11% quarter-on-quarter growth. Operating margins also improved from a previous 24% last quarter to 28% this quarter. However, there seemed to be a huge increase in losses booked for the unallocated corporate cost segment. As you can see, this might be due to the latest changes in restructuring and layoffs from the company, where they represent Alphabet-level activities such as R&D into the AI. They mainly comprise of corporate shared costs in HR, finance, and legal. In my previous quarter's Google results release, I mentioned in my video last month that we will see higher margin squeeze on its operations due to higher costs in its fourth quarter, and I was really wrong. Little did I know, revenues from all segments grew faster to offset its costs. Operational efficiency probably played a part in driving down costs and thus causing operational margins to stabilize. I'd rather be conservative and prudent in my estimates though. Anyway, this is good news for Google, as management indeed walks their talk. Now, we shall look at the peers segmented business, in this case, Microsoft's recent results to compare, so you get a better picture on both companies' relative performance. Even though both businesses use slightly different reporting standards and may operate in a different business environment, I think we can use this information to paint a snapshot of the tech industry's business environment this latest quarter. We can then deduce a valuation relative to both companies. Microsoft's segmented revenue growth year-on-year grew slightly more than Google at 14.9% versus a 12% for Google. If we look at quarter-on-quarter overall revenue growth for Microsoft, this grew 9.74% versus a 14.6% for Google. Therefore, in both fronts, Google seemed to have closed the gap this quarter with Microsoft's performance. Microsoft Cloud revenue, however, seemed to continue to grow at exceptional rates of 17% year-on-year and 7% quarter-on-quarter. Microsoft operating margins, however, declined from 47% during its last quarter earnings to currently just 43%. But at 43%, I think its margins are still superior in terms of earning power. Google's operating margins have come down, but only by a slight negative 1%. Microsoft Productivity and Business Processes segments mainly consist of the Microsoft Office commercial subscriptions, Microsoft 365, Linking Business Solutions, and Dynamics 365 businesses, all of which employ the SaaS type or software as a service type of business model and have proven to be a highly profitable market for Microsoft due to its relevance and value add in its own market space, which is in enterprise. While Google's reliance on advertising and search is slightly more cyclical in nature and thus produces lower margins compared to that of Microsoft. Markets have always attached a higher premium to Microsoft share price, and based on PE, is currently trading at 35 times its 2024 forward and 13 times price to sales, while Google is currently trading 30 times its 2024 forward. There will be more on Google's valuation breakdowns later in this video. Let's now look at Google's management outlook for this year. CEO Sundar Pichai maintains focus and commitment to bring down costs and streamline operations within the company with AI initiatives. Gemini Ultra will be launching this year, and Gemini Ultra is Google's largest and most capable multimodal model designed for highly complex tasks and built to quickly understand and act on different types of information, including text, images, audio, video, and even code. You can see a snapshot of the intelligence scoring here for Gemini's Ultra versus ChatGPT 4.0. Even though Ultra has beat the scoring of ChatGPT 4.0 in many test points, this is just an internal test. We as users need to be able to try it ourselves to be able to really feel the product and compare it. I am indeed excited and can't wait to experience or hear more about reviews of the Gemini Ultra later this year. Across different teams, Google have wound down some non-priority projects, improving machine utilization, building on years of experience in driving cost efficiencies in computing infrastructures and operations. And through supplier efficiency efforts and automation of certain processes, Google made major improvements in areas like procurement, achieving significant savings for the company. For example, the GCS team at Google delivered particularly strong growth in Q4, so there have been adjustments made to focus on more resources on the GCS side that will create more solutions to small and medium business enterprises and help them scale up to become Google's largest customers eventually. The restructuring will lead to severance costs of approximately $700 million in the next quarter. Management has also mentioned a change in the business structure of Google's Other Bets segment in 2024 to create greater efficient use of capital allocation within Google. as you can see from the news screenshot here, a snapshot here. So Google X announced that it would be moving to spin off more projects as independent companies through external capital, giving Google X the opportunity to bring more focus to breakthrough technologies it is working on. This structure may free up some of Google's internal cash flow for better use, and the spin-off with external funding could also add more value and competitive innovation advantage among the teams. But this may present tougher and less transparent means to identify potential impairment losses on its other bets investments going forward, as it may take things off the balance sheet. I've tracked Google's sales from 2005 to 2023, and its P&L summaries is drawn here. Google has shown resilience in its revenue growth and net profit margins since 2005. You can see here that net profit margins are mostly above the 20% range. Such businesses are a rare find, and if you can purchase such a business at good prices, you will definitely reap decent rewards if you hold on to the company for the long run. In fact, during both the global financial crisis in 2009 and the COVID crisis in 2020, Google managed to maintain its decent performance. This gives me the confidence that Google's business may be resilient even in times of a crisis. The possibilities of scale is also set to be bright for Google as they venture into generative AI across all their product offerings. We can already see cost optimization taking place as margins have improved from 2022 to 2023 from 21% to currently 24%. Revenue for 2023 grew 9% year-on-year, and net profits grew at a good 23% year-on-year. Hopefully, we can continue to see further improvements this year. Let's look at this quarter's costs for Google. Total acquisitions costs for the full year grew at a slower pace compared to 2022. The increase in total acquisition costs this year was largely paid to distribution partners, primarily driven by growth in revenues. R&D full-year expenses increased $5.9 billion, mainly due to compensation costs for the R&D team and higher depreciation on the servers and network equipment earlier half of the year. Sales and marketing expenses was also up $1.4 billion, mainly due to compensation expenses, but was offset slightly by lower marketing costs for the year. I noted that most of 2023 expenses was related to compensation expenses. As mentioned earlier, in the management outlook section, we will be seeing a further $700 million charge to compensation expenses in the first quarter of 2024. Should we continue to see layoffs this year, we will continue to see booking of such expenses into these categories in the year ahead. We will also be expecting higher lease commitments of $3.1 billion in 2024. For the balance sheet, Google's net return on its assets after minusing debt remaining at above 10% since 2005. Net ROA for the year have improved to 26% from just 20% in 2022. Net tangible book values also increased 74% to $20 per share this current quarter. This gives a price to tangible book value per share of 9% for Google. Average cost of debt across the board is currently at 3.38% with an interest coverage ratio of 273 times. This coverage ratio reflects a healthy earning metric that covered Google's interest costs with a wide margin in 2023. Google's free cash flow for the fourth quarter 2023 improved slightly at just 1%. Google's price to free cash flow is at 142 times this quarter and is a slight improvement to the previous quarter. I hope that with the new structure of in the other bets or Google X rolling out within the year, we might see improvements in free cash flows and also its return on assets. CapEx to sales is in the current quarter stood at around 8%. versus 9% in the previous quarter. This means that CapEx relative to sales is rather reasonable for Google. The $11 billion CapEx booked this quarter was heavily weighted to investment in technical infrastructure important to the AI vision of Google, and CapEx is expected to continue to increase next quarter at a similar rate to the fourth quarter. Even though Google's share price recently is down from its peak due to investor disappointment, let's take this opportunity now to weigh its earnings power to derive a fair valuation for Google. Google's current forward PE is at 23 times. Its median PE is at 28 times. Industry PE is currently at 39 times. Based on my PE forward valuation metric, which I have revised upwards compared to my previous episode to reflect the higher forward earnings this year, Google's share price to me should be around the $165 to $175 range. I have revised my discounted cash flow model for Google upwards to reflect the possibility of a first quarter 2024 improved earnings result. Based on my DCF valuation, Google should be priced at 2 times its 2024 forward earnings. My current expected valuation of 2 times is a far cry from today's valuation of 5 times its revenues. This gives me an implied earnings growth rate at my purchase price of 9%, which is rather risky and leave little margin of safety should any of my estimates go wrong. That being said, at today's prices, Google has still room for growth if we have not priced in its future AI capabilities on how it will impact ad revenues and also its next generation of search. Based on my new framework, designed to give an overall health review of my investor companies going forward, I developed a grading system of the most important factors of my investment checklist so that I could formulate a call to action of whether to accumulate, wait, or reduce my existing stock positions. For Google, I have given an overall rating of a B grade for my future business expectations of Google, as I believe that it is poised for better growth prospects ahead. The recent sell down is therefore unwarranted. Should prices reach close to my margin of safety again, I will not hesitate to increase my position on Google, as I feel that my current weighting on Google is slightly low relative to my overall portfolio. So till then, on my next video, I shall see you guys again, and let's for the win. Have a good day and goodbye guys.